Okay, so good evening, everybody. You're very welcome to our seminar this evening about how to claim your tax rebate against 2021. So you're all very welcome. Just to give you a guide of what we're going to do this evening. So we obviously have some information for you on the slides. Myself and Tom are going to talk you through them. And then I suppose, look, we was going to stay on at the end, Tom, for about 10 minutes for Q&A. Sure. So I think people can use the chat function at that stage. So the chat function is going to be closed while we're doing the meeting. People have submitted a lot of questions when they were RSVP, and so we're going to cover those questions as we go through the slides. But as I said, myself and Tom are happy to stay for the 10 minutes at the end if people want to throw questions up on the chat. Sure. So yeah, that's just a couple of house rules or whatever. So look, I will introduce myself and Tom to begin with. My name is Claire Hanrahan. I'm the COO of Irish Pensions and Finance, and I'm joined this evening to Tom Corcoran. He's one of our senior financial advisors. So very welcome, Tom.
Thanks a lot, Claire. Great to be here.
Great. So I suppose, look, we call this time of year our lump sum season. And I suppose, Tom, it's always really busy for financial planners, you know, coming up to the end of October, isn't it?
Yeah, for sure. I mean, look, I'm here over 10 years now, would you believe? I obviously just joined straight after my confirmation. And this is the time of year where it's hectic, you know, so I think it's a really good idea to put something like this together for people so they can prepare for it and we can prepare for them, you know, and be ready for it really, because it is an onslaught, as you know, this time of year coming towards October. Very good.
So yeah, look, we're launching our lump sum season by starting with this seminar. Once this is over, I mean, tomorrow, Sarah Connolly, and I just want to say thanks to Sarah, who's organised and is producing this whole webinar, we'll be sending out a pack to everybody who's here this evening and RSVP. So there'll be a lot of information sent out to you from this evening. And we're also going to run a little competition to keep it a bit interesting. So at the end of the slides, we are going to ask you a question that came up throughout the presentation, and the first person with the correct answer on the chat function will win €100 all for one voucher. So just to make sure you're listening and you're staying on your toes.
Claire, can I just ask you on that, do they have your title right there at the moment?
Oh, I think they might do, Tom.
They do they? Okay.
Very good.
Okay, just to check that.
Great. Okay, so look, we'll get going. So that's the introductions done and the order of the evening. I'd say, by the way, I think the slides and haven't done the run through already this evening. We might be maybe half an hour, 40 minutes max. And as I said, we'll hang on for some questions at the end. So as I said, you're very welcome. Irish Pensions and Finance, a lot of you will know who we are. Just a brief overview. We were established in 1993. So we're going to be 30 years in business next year. We're really proud of that. At the minute, we've over 24,000 public sector policyholders. A nice number that we love to see is we've over 3,500 of our clients have retired. So that's really, it's great to see them on the journey and getting to that destination of retirement. We've 144 public sector payroll schemes where you can do your AVCs. So some people on the meeting this evening may have AVCs. Some people might be considering looking at them. We've over 600 million funds under management. We're an authorized advisor. So what does that mean? It basically means we are an independent brokerage. We don't work for any one company. We work for our client. We work for you. So we can put the business wherever is in your best interest. We have a dedicated team of qualified financial advisors. At the moment, we have 38 financial advisors who help you with your financial planning. But as well as that, and something that's really good is we have a really experienced back office staff. The majority of the people who work in operations are QFA'd or sitting the exams. We run what's called a service centre. So what we love about that is basically our clients can ring up IPF during the week, during working hours, and they can talk to a financial planner straight away when they ring up. So we really kind of feel that when people put the time aside to ring the company, that they get to speak to a professional and they're not put on hold and waiting for ages. So we started the service centre in February. It's going really well. And then we also have a retirement help desk. So when people retire, they're not just, it's not finished, and they can ring up, and we have a retirement officer on the line there that can help them with any of the queries and questions they have once, you know, they've retired and the dust has settled. So that's Irish Pensions and Finance. Great. So Tom, we're going to get going.
Great.
Okay. So Tom, few dates here.
Okay.
Why are these dates important? What do we know about them?
Okay, so what we're looking at here are the revenue deadlines. Okay, so these are important for people who want to make a lump sum contribution to a pension and claim some tax back for 2021. Okay, so last year, right? So there's a revenue deadline of the 31st of October, and what that really means is for PAYE workers.
Okay.
Which most of our clients be public sector clients, they'll be PAYE, that they have until the 31st of October to make a lodgement if they want to a pension or AVC and claim tax back for 2021.
Okay, so 2021 is not over from
it's not gone, no. But I suppose the key thing, Claire, is that if you don't claim tax back before the 31st of October this year, last year is gone to you. Okay.
Okay,
so
it's gone.
It's gone. Can't get it back.
Okay, but they give you this 10 months grace.
They do. Yeah.
Okay, because you know the way you'd always hear ads on the radio about these deadlines. So this is what they're talking about.
This is what they're talking about. Like, so you'll hear it on the radio. This is what they call pension season. And, you know, the ads are saying, look, you know, get a lodgement into a pension before the 31st of October. You'll also hear the 16th of November. But if you're PAYE, don't make the mistake to think that you have up until the 16th of November. That's for taxpayers who pay and file through ROS or through the ROS system. And for the most part, that'll be self-employed people.
Okay, so PAYE 31st of October is a big date.
Yeah, yeah.
Right.
Yeah.
I had a question from Michelle in Mayo. She said, like, I've already submitted my Form 11, paid my tax for 2021. So can I do anything? Or is it all done, finished?
Yeah, no. So the Form 11, okay, Michelle's already made a return, but she can still make a lump sum lodgement to a pension or an AVC and claim tax back for 2021 if she wants to. She still has time, but that deadline
that's good news.
Not gone yet. Yeah.
Okay, perfect. So I think that's really clear. 31st of October, important date, and then once that's finished, you know, we're past that, then it's gone for 2020.
Yeah, it really is a use it or lose it deadline. You know, if you miss that, it's gone to you. You know, unfortunately. Just on that, Claire.
Yeah.
You know, I know we were talking earlier on that. I think you were saying the 31st of October is actually a bank holiday. So,
it is. It's a Monday bank holiday. So
yeah, so really need to be in before that. To be fair, you know.
28th is the Friday. Yeah. Okay.
Yeah.
Well, look, put those dates in the diary.
Great.
So the moving on then, Tom.
Yeah.
So how much can I claim?
Okay.
So on the left here, we're saying, like, you know, there's 3 things we need to consider. So can you talk us through these points?
Yeah. So, you know, I suppose how much you can claim, and this is really important because we see mistakes made here for people over the years, right? So a lot of our clients might just Google this and say, you know what, I'm 30 years old, I can put 20% of my salary into a pension or AVC.
Yeah.
But the key thing is, and while they can do that, okay, we would suggest you get a little bit of advice. Okay, so what you need to take into account is, for example, for a lot of our clients, if they're in the public sector, they'll already be making contributions to their superannuation scheme. So we have to allow for that. That takes away.
That's part of the percentage.
That's part of the allowance, okay? And then you might find that they could be making AVC contributions on a monthly or fortnightly basis as well. So again,
you have to account for that.
You have to account for that. Yeah. So you make allowances there. So what we would suggest, look, the figures are there. They're the guidelines, let's say. They're the allowances, the thresholds that you have. But again, I just suggest get a little bit of advice before you do anything. And what we do in here, you know, we'll calculate it. We just get a copy of a payslip and work through it with the client and work out the exact, you know, amounts they can put into the AVC if they want to, before the deadline, you know.
That's great. Now I had a couple of questions on this particular slide, Tom.
Sure.
Because it says here, is there an important difference between like earned income and, like, because I had a question from Chris in Loud. He was like, I have a rental property, so you know, I'm earning income from that. Okay,
so it's a question actually that happens quite a lot. So technically speaking, and I don't want to get too technical, the rental income is not allowable, okay, for pension contributions. So it has to be earned income, okay?
Okay.
But what we would do for someone like Chris, so for example, let's say Chris is working full-time in the public sector. He may not have used his allowances for AVCs last year.
Okay.
So we would look at that, and for example, let's say Chris is age 40 for now, right? He has he can put 25% of his salary, less superannuation and less any
things
AVC
we just spoke about. Okay.
Yeah. Okay. And then we can calculate how much, if any, then he could make as a lump sum contribution to an AVC from his earned income. And he might find, or he will find, that'll offset some or all of the tax liability that he has on the rental income. So while he can't put the rental income directly into the pension, he can use his PAYE income to do so.
Okay. I suppose, look, that's something that an advisor would talk to you about.
Oh, yeah, absolutely. Yeah.
And I suppose then, is it only, you know, and once again, we're going to talk a little bit more about how to do it and how it works and who it suits. Okay.
Sure.
But is it only tax relief you get? Do you get anything on PRSI and USC?
Unfortunately, now it's only tax relief. So it's at the marginal rate. Okay. So again, we'll be able to.
And so what does marginal rate, Tom, mean?
Sorry,
for those, like, you know.
Yeah, that's fair enough. Thanks there. So we would look at the marginal rate is the rate of tax you're currently paying. So some people will be at 20%. So some people will get 20% relief. Others will be on the higher rate of 40%. So they get 40% relief. Or it could be a mixture of the two, depending on the income. Again, that's part of what we do. We would look at the pay slip. We'll be able to work out exactly what tax you're paying. We can actually work out how much tax you're paying at the higher rate and the lower rate.
So yeah, the pay slip tells a lot.
Pay slip does tell a lot. You know, some people don't like looking at it at the minute with the USC and everything else going on, but it's worth getting a bit of information on it anyway. Yeah. Very
good. And then I had another question then. So I'm just thinking, say my birthday falls in the middle of the year. So the year I turned 40. Okay.
Okay.
And if my birthday's in June, like, what way does that work? Because I'm between two bands. So is it like half the year age 39, half the year 40, or what way does it work?
Well, the good news, Claire, and happy birthday, by the way. The good news is that you then increase your threshold. So for example, let's say you were 39 up until June this year, right? You might think you can only have 20% of your income as an allowable input into your AVC. But the actual threshold is 25%. Because it's done in the calendar year of your birthday. So
it's my 40th year.
Yeah, your 40th year. So your birthday could be the 31st of December. And actually you could go in and take 25% out. So yeah.
That's great. Okay. So for anybody who's kind of hitting a milestone, that's something to consider.
Yeah, they increase their thresholds then. Yeah, absolutely.
Brilliant. Okay, that's great. Well, we'll move on to the next slide.
Okay.
So we have an example here.
Yeah. So look, this is a fictional example, you know, so it's just, I just thought it'd be a good idea to show people in practice really how it works, you know. So we were saying earlier on, Claire, that, you know, a lot of people just look at hear the ads on the radio or Google this because, you know, it's topical or will be topical in the coming weeks. But it's important to note, so this lady we're taking as an occupational therapist, earning 65 grand in 2021, and she's 57 years old. Okay. So what that'll tell her is that she's allowed to put 35% of her income into an AVC. Okay. So, and there's quite a lot of money here. So it's 22,750. But the key to note is, we mentioned this a little bit earlier, that Mary pays superannuation contributions of, in this example, 5%. So that's 5% of her salary that she can't use to AVCs. Okay. And also in this example, Mary's already paying, you know, 3,000 a year into her AVC on a regular basis. Okay. So the thing to note on that is she can do both, first of all. So she can make a regular premium and she can do a lump sum. Okay. That does confuse some people.
Yeah, they think I have to do
one or the other.
Yeah.
Yeah.
And I think the thing as well, though, the regular premium is good because you're not just investing on one day of the year, you're investing, like, you know, every month or whatever it is.
Exactly. Yeah. You're evening it out over the year, you know, and you know, quite often a combination of both is the ideal situation. Okay. So in this example, then we have to allow for Mary's superannuation contributions and what she's putting into the AVC. So in reality, then, you know, out of the 22,750, she's actually left with an allowance of 16,500.
Oh, so it's not just if she went 35%, it's 22,750. You have to be careful.
You got to be careful, because you will hear the ads, and a lot of these providers that you might hear online or whatever will say, look, just get the money in, etc. Right? But part of what we do is we make sure for Mary that if it makes sense for her to put money into the pension or into the AVC at this stage, that it equally makes sense coming out. And I know we'll talk a bit about this later on as to how Mary draws this down. But it's good to note that in this example, you might Google it and think, look, you've nearly 23 grand there to play with. But in reality, it's only 16 and a half, you know?
Okay. Yeah. So we need to have a look at those figures. Great. Okay. So that's fine. So let's just say this all works out and she's going to go ahead and do her 16 and a half. So the next slide we're going to look at is how does it work?
Okay, so I suppose it can be very straightforward, and I know the people on the call at the minute are going to get a pack tomorrow. Okay, and I
Yeah,
suppose the part of that pack is going to be a step-by-step guide, and it's really worth reading that, and we'll mention that in a second. But I suppose the first step is for Mary or whoever to clarify the figures with a financial advisor. Okay,
yeah,
so pick up the phone, send an email, get the advice, and make sure you get your figures correct. Okay. Then, in this case, then she can either transfer the money to her AVC provider by EFT, electronic funds transfer, or check or bank draft. Okay. So that check or bank draft or EFT is sent in to the AVC provider. There is, charges on that.
Okay, so yeah, net of charges, yeah.
Net of charges, yeah. So charges on that, and it's worth noting on that. And just on average, Claire, approximately 3% of whatever is lodged is going to go into these over time there,
Yeah.
So once that's done, okay, Mary will then get a receipt as proof of payment, okay?
So who does she get that from? Does she get that from?
So she's going to get the receipt from IPF, and actually
she does lump sum with us. It's not like New Ireland or Zurich. It's
so it's us, it's IPF. So for example, if the check or bank draft or EFT is going to go to New Ireland or Zurich or whoever the AVC provider is, but we will issue the receipt.
Right. Okay.
So once Mary gets the receipt, she'll get it ideally, firstly actually by email, and then eventually by post. Okay. But the key to note here is, and I know we mentioned this later on about time and that, but it's key that once she gets the receipt, she should really and can go on and claim the tax back straight away.
Go for it straight away. Yeah.
Go for it straight away. Don't wait till October.
Yeah. And I think, like it says here, like our receipts come with instructions.
Yeah. Yeah. And the instructions are very good. They've screenshots of each page if you're going online to do it by revenue. So it's very step by step, very easy to follow, so you can print them out and go through it.
And just a quick one, like say for instance, Mary doesn't actually have an AVC with us and we discover this, what does she do?
Yeah, well look, it's if that's the case, she can set up an AVC, so it's not too late. But
she's
I would suggest,
though, like,
sorry?
Yeah, so it's not too late. She can set up the AVC.
It's not too late, but again, I'd suggest she acts quickly, because like everything, it takes a little bit of time to set up an AVC. It's going to take time to fund the AVC, to lodge money to it, and I suppose just on that, another few little things to note, and these are things we've seen over the years, that some of the banks will only allow you to transfer a certain amount on a particular one day, so you might want to lodge, if you're lucky enough to have 16.5 grand, that might take you 3 or 4 days to do. So again, I think starting earlier is key to this. Don't leave it until the deadline.
Right. So then what happens then? She files a tax claim.
Yeah.
And
obviously states that you claim tax rate for 2021, and then revenue will then send Mary a check for 6,600 in this example, so she gets to do what she wants with that. Again, we might find at the minute a lot of our clients have this money sitting in bank accounts, not doing very much at the moment. So again, what we recommend on that, and it's just worth thinking about what you're going to do with the refund. So the good news here is the 16.5 grand has gone into the pension. It's worth noting that that's not allowable, or she can't claim that back until she actually retires. Okay. So that's a key point. But she will get 6,600 back. And the best thing about that is just to maybe plan for spending that. If she's going to spend it or do something with it, she might want to invest that separately, do something with that over time. So it's just an idea to think about it. We all know, you leave that sitting in a current account, it's gone. Absolutely.
You don't spend it, somebody else will spend it.
Well, absolutely.
Great.
A few people.
Great, yeah. And I think we're gonna, at the end do a kind of do's and don'ts, know. But look, this all sounds great, Tom. But I'm assuming that, and I think it's important that this can suit some people, but it doesn't suit everybody. And we need to be really, strong, and just to say, look, this might not necessarily suit everybody on the call.
Yeah, like that, everybody can potentially do an AVC, or everybody can make a lodgement to a pension, but maybe they shouldn't. Okay. So
what would the reasons be then? Yeah,
well, so I suppose the first thing there is that if you're very close to retirement, so people with less than 2 years service to go to retirement who don't have, any shortfall in service, for example.
And they haven't been building up AVC. They're just looking at it for now.
Yes, they're just looking at now. So if you're going to have 40 years service, 42 years service, and you're going to retire in the next year or two, this probably isn't for you, quite honestly, you know. And then again, we have to note that if you're a higher rate taxpayer today, okay, which is great, you get 40% tax relief going into the pension at the minute. But if you're going to be a 40% taxpayer in retirement and you're going to retire in the next 18 months, is there really any point in doing that? And I would argue there's not. Because when you do come to take it out, if it's not tax-free, which it won't be, you'll end up paying the tax back along with, you know, PRSI, etc. So it's not worth doing. And then obviously people then, if they've no non-pensionable income, you know, this then doesn't suit you.
Okay. So what's a non-pensionable income? An example of that would
so
be?
Equally, like, so again, having non-pensionable income means it will suit you if you're within the last 2 years. And what a non-pensionable,
when we say non-pensionable, is that like overtime, on call?
So on call, overtime, that kind of thing.
Yeah, taxable but not pensionable.
Taxable but not pensionable.
Okay.
You know, so that can increase your lump sum, your tax-free lump sum at retirement, you know. And look, we find, Claire, actually, that on that, you know, you might find someone that's maybe not doing overtime in the last 12 months, but they did it 5 or 6 years ago.
Yeah, because I actually had a question. So as we're closing off who it may not suit. And look, you know, if someone comes to talk to one of the advisors and it doesn't suit them, we will tell you.
Tell you straight away. Yeah.
There's no benefit to doing it.
Yeah.
Okay? So that, don't worry about that. But what we're saying here, on the third point of who it may suit, because Brendan in Dublin, he was saying, like, he's you know, he's coming towards retirement. He's in his late 50s. He does overtime, but not as much as he did in his early 50s. So he was wondering, how far can he go back, Tom?
Okay, so, you know, we'll do the work with Brendan on that, okay? So he can go back 10, 12 years on the overtime that he did do, okay? And I don't want to get too technical on the actual process there, but quite simply, we'll go back and have a look at his earnings for those years.
Yeah.
We'll take the highest 3 years earnings in the last 10, for example, or the highest 1 year in the last 5, okay? And he can use that, and the term is dynamization. He can dynamize that.
What does that mean?
Salary. Okay, so look,
dynamization.
Yeah, word. I know, getting very technical on this, but I suppose, look,
fancy word for inflation. Yeah.
Inflation is the key word here. We're all talking about inflation at the moment. So basically, he might find that 5 years ago, for example, he was earning more because of overtime than he is today.
Yeah.
And he can use that figure to inflate his figure today. So revenue will actually issue us every month with you know, inflation figures, let's call them, and we can apply that then, and then help Brendan to increase his tax-free lump sum by using an ABC. So if you do have non-pensionable earnings, you know, this might very well
and you were maybe doing more of that work, you know, previously, like in the last 10 years. It's definitely it's a way of talking your lump sum.
Yeah, don't let it go back, we'll do the sums for you, you know, with the information, and see what you can do. Absolutely.
And so just going back there, Tom, so it may suit people with short service.
Yeah, so, like, I mean, when you're looking at somebody doing AVCs or not, you're looking for them, I suppose, to see, will it suit them or will it not? And reasons that it will suit somebody is, you know, we find a lot of women particularly might work part-time or might take time off to look at kids, and that's just the trend. I'm not saying that women only do that. It's just
more and more men are doing it now.
More and more men are doing it now, you know,
sure.
but we do find that a lot of people now will have short service. A lot of people are joining service later in life, that kind of thing. So if you have short service, you can look at the ABC as a way to build up the gap that you may have, you know. Another good reason below that is that you might be a higher rate taxpayer now, and you know, you're going to fall off a tax band in retirement. You're going to fall off a tax cliff. So if you're a higher rate taxpayer now and you're going to drop to potentially a 0 rate taxpayer or a 20% taxpayer in retirement, then it really does make sense.
Yeah,
it's a bit of a
no-brainer. You can like look at your spouse's income as well, and
and you know, again, like when if we're talking to people, we will always ask them to get their spouse involved. You know, and it's key to do that, because as well as anything else, you know, it's great to look after your own pension, but you might find in the household you might be the only person that has a pension in the household. So is that pension then for 2 people? And if you stress test that, is it going to work? So again, people in the private sector, so you know, they can still do lump sums, not necessarily to AVCs, but they can make pension provision for themselves.
Very good. And then the last thing here, Tom, it says those building up an ARF for retirement. So I think we're going to have a little look at the approved retirement funds in a minute. But I had a question from Carol. So she was saying, like, when can I draw down this lump sum and how?
Okay, so it's a really good question. Okay, so the first thing to note is that, you know, the AVC schemes that we run in this in the public sector, right, are really in conjunction with the superannuation scheme. So you can only access the AVC when you access your superan scheme. Okay,
That's important.
it is important. Yeah, I know a couple of years back there was a bit of a thing that people could access money, but you can't now. So this money is
kind of married together.
Yeah, they run side by side. So you can only take money from the AVC when you actually retire.
Okay.
You know, so you know, some people use the AVC actually to retire early, Clary, as you know. You know, so that might be one way to access it. And actually, unfortunately, sometimes we see people accessing their AVC in ill health. So if they have to retire.
Oh, right. So if you retire in the grounds of ill health, it'll be available then as well.
The AVC is available then.
Right.
Yeah,
So once you get your pension is the key.
Yeah. So once you receive your pension, it's accessible.
So then I think the first thing we'll do is, you know, we will see what can we get you tax free. So the first thing we'll do is max out the gratuity, the lump sum.
Yeah. So that's the first thing we always do. Everybody likes to get tax back. So when you're working, it's great to get tax back by lodging money into an AVC, get the refund. But when you retire, we always look to see, can you get some tax back, tax-free money? So if you're short service,
you're once off, you know, tax-free lump sum, you've only one chance to get it out.
One chance to get it. Yeah, it's a bit like the revenue deadline, you know, it's a use it or lose it thing. You know, you can't retire and then 6 months later come back and try and get it. It's gone to you. So
that's great. So once we say, right, okay, you know, Joe, here's you know 20 of the 100,000 the AVC, the first 20,000 is tax free, going on everything, all the figures we have and everything. So he has 80,000 left over, for instance.
Yeah.
So we've spoken here about building up an ARF, an approved retirement fund. So can you talk to us a little bit about what that is and how it can work, and you know?
Sure. Okay, so look, I suppose, you know, a lot of people that'll be on this call will already have AVC funds with us, okay?
Yeah.
So I would look at the ARF as an extension of the AVC. So, you know, you'd have this product quite a long time, and it's just really a change of dynamic with the same fund sometimes. But an approved retirement fund, it basically is a way of making the AVC money available to the person, available to the client, okay? It's very flexible, okay? So the first thing there is, it tells you that it allows you to remain invested in funds after you retire, okay? And you can draw.
So let's say the example, Joe's 80,000.
Yeah.
Once he does everything and processes everything, and he's retired.
Yeah.
He can put it into he has an option of buying an annuity, which is something we can look at, which is buying income for life.
Yeah.
The majority of our clients who have, it's a minimum of 20,000.
Yeah.
They, you know, so this example is 80,000. He puts it into this approved retirement fund. Yeah.
So once he puts it into the approved retirement fund, okay, there's a couple of rules around it. And as I said earlier, it's about this being accessible to the client. The first note is that, I think it's a point 4 there, is that you must take 4% out per annum anyway, okay?
Once you're 60, isn't it?
Yeah. So once you are retired and have your money in the ARF, you've got to take 4%. Then when you're 70, you have to take, it increases to 5%.
Okay. So you can't just leave it sitting there.
You can't leave it sitting there. This is Revenue's way of getting some money back out of you. They've given you all this tax relief over the years. So now they actually want you to spend it and get some money out of the system. Okay. The few notes on the ARF, the approved retirement fund, is that growth, like your AVC, okay, is tax-free over the years. Okay. So ideally your AVC is growing and it's benefiting from compound growth over the years. Okay. Unlike anything else, unlike any other investment, that growth is tax-free.
So they don't tax the interest that you're
There's no tax. So for example, if there was at the moment, you know, banks are not really giving much of a return, if any, at the moment. But if there was growth on your money, if it was invested with a bank, you would pay DIR tax, you know, at 41%. This thing grows tax-free in the AVC and continues to grow tax-free in retirement in the ARF. Okay. Okay. So it's a really important point to note that.
That's great. But I suppose what I'm thinking is, when I take the money out of it. So say I say, right, Tom, or Joe says, I have 80 grand here, Tom. I'll just take out the 4% to start with, because I have my lump sum over here and blah, blah, blah. Yeah. What happens to the 4%? Is that taxed?
It is, yeah. And
Okay.
I mentioned marginal rate earlier on, and I got the head taken off me for saying it. So it's taxed at whatever rate that Joe happens to be on at that time.
Okay.
So you know, depending on his income.
Treated as income basically when
Yeah,
you
it's
calm it
treated as
down.
income tax, you know. So again, our job at that stage is to advise Joe how best to take it or to tweak it. So you might find that if you tweak it a little bit, you might just keep the client under the higher rate tax threshold.
That's
Again,
fine.
we mentioned earlier on, if they're married, you might bring the spouse into that situation to allow them to take more money out, actually, at the lesser rate of tax.
So you
You
can
know?
box clever with it in some circumstances.
Yeah, yeah. So I mean, if you have people, and you know, there'll obviously be clients on the call here that are already ABC clients, they'll know that, look, we keep in touch with you every year. We'll do a review of your ABC every year, show you what's going on. We continue to do that in retirement, and it's probably even more important, I think, in retirement to do that. And the retirement help
Yeah.
desk will tell you they get these calls all the time, you
Yeah.
know, because people, you know, they might take out 4%. Can they take more? Can they, you know,
And they can take more is the answer.
they can, absolutely.
Depending
Yeah.
on the provider you go with. Some of the
Depending, yeah.
providers let you take up to 15%, I think.
Yeah, you could take up to 15% is the maximum at the minute, actually. You know,
Sorry, Tom, I'm going to ask a question. So that's great. If
sure.
you know, we love the people who are high rate tax now, low rate tax in retirement, and if they're taken out from the approved retirement fund, try and keep them out of the high rate tax.
Yeah.
Is there any point if I'm high rate of tax now and still high rate of tax in retirement? Is there any point of having an approved retirement fund?
Potentially there is, yeah, absolutely. So a lot of, you know, higher earners now, you know, be looking to do something with their money, you know. So at the moment, they can invest this money into a pension, an ABC, for example, and get, as I mentioned earlier, the tax-free growth on that money today.
Yeah.
Okay, so there's absolutely no tax on that until you retire. Okay, so that benefits them by growing, okay, free of tax. But in retirement also, any growth in that fund is tax free. So, you know, although they will pay tax on it as income, you know, they're really in this thing then for the growth over the years, the compounding growth over the years. Okay.
So yeah, because I think we see sometimes that even though they're paying the high rate of tax on what they're taking out, the interest in the fund can actually pay for a good bit of that tax.
It can cover that, you know, absolutely. And to be honest, we kind of see a really good reason for higher earners in retirement to have a backup fund anyway. When you look at the way
gratuities run out by the age 65, 70.
Yeah, it's gone. You know, inflation at the minute is in the news day in, day out.
Yeah.
You know, it's nice to have a backup fund there, you know, and if you end up paying tax at a higher rate, it's still better to have it than to go looking for it.
And what's your experience then? Like, because I know the 4%, you know, when they're choosing the option, they can go monthly, quarterly, half yearly, annually. What's your experience with our retired clients? Like, what way do they take it? What do they use it for?
Yeah,
how do they find it useful?
Yeah, it's really interesting to see how people do it and the reasons actually why they take money. So what we find is normally in the first year or so, people are just kind of getting used to their new dynamic. They're getting used to being retired, getting used to reduced income in most cases, you know, and they'll take the 4% out because they have to in year one. But when we're talking to them then in year two, they're looking, you know, at what's actually going out of their account every month or what the big expenditure are. So for example, I have clients at the minute that are have us sending money to them every January because that's when they pay their VHI, for example.
Okay, and that's really important when you're retired to keep your VHI up.
Absolutely, you know, and it's nice to have
a big ticket thing.
Nice to have a backup fund there just to pay for these things that none of us really want to pay for, you know, and we don't like paying for these things like VHI. Other people then will have
car tax, home insurance,
stuff like
that.
The big things like that. So you could have it monthly.
You can time it like
every
that.
Second month, you know.
Very good.
And then others will take it for, you know, Christmas for grandkids to spoil them, or indeed for holidays for themselves, you know.
Right.
And
it doesn't interrupt their pension.
No, absolutely. Right. It's separate to it. So they get used to the pension income, they live off that, and then sometimes they use the ARF for the extras.
Excellent. I think a couple of other points there, just like, so poor Joe, year into retirement, and there's 78,000 left in the fund or whatever there is, and he dies. What happens?
Oh yeah, well look, well what happens there is the ARF fund becomes part of Joe's estate.
Doesn't go back to the bank?
No, it's not lost to him. The family is getting it, the spouse, the family, whoever it is, they're going to get that fund.
Brilliant. Okay, so that's good. Doesn't die with you. I hope Joe spends it all now, to be fair.
Please God he gets to spend it all. But yeah, you know, it's a fact of life, unfortunately.
And then what does this bomb out risk mean? What does that mean?
So yeah, look, you know, this is very important because I said earlier on that, you know, we have the retirement help desk now, and that we will talk to clients in retirement. So I said earlier on that it's nearly a more important conversation when you have retired than it is while you're working, because while you're working, you know, funds go up and down in value, you can replace them with your earnings. But a bomb out risk with an ARF is if someone doesn't manage their money properly. So we take Joe as the example, poor Joe, having a terrible time, but he has 80 grand. He might take out, you know, 15 grand a year for that.
They're taking loads out of it.
Taking loads out, going to Las Vegas, having a great time for 4 or 5 years, and then find out, well, hang on a minute, you know, I haven't been getting 15% growth on my money. It's all gone.
Okay, so bomb out means gone. You spent
bomb out is gone. Yeah. So you got to review it and check it regularly and just make sure it's doing what it should do. You know?
Well, look, just before I want to move on, because this seminar this evening, people have jumped on because they want to think, they're thinking about, should I put a lump sum into against my pension for last year? But I think we kind of came up with a few do's and don'ts.
Yeah.
And this is from what we've seen over the years.
Yeah. Okay, so I suppose the first thing is, right, if you're on this call, you're probably thinking, should you make a lump sum contribution or not? Okay, so what I would suggest is, whether your mind is made up, and it probably won't be at this stage, is log on to revenue.ie and create a My Account straight away.
Okay. Does that take long, or does it?
It's not that it takes long, Claire. The big thing with it is, if you leave this late, you'll get the account set up online straight away, but they post you a PIN number that you need to activate it. And the problem there is that if you leave this thing too late, we mentioned earlier on, you have to claim everything by the 31st of October. You might just log on and not get the PIN number in time, be left waiting for it, and lose your refund, you know.
But I think the My Account is good because, you know, you can kind of, when you're on it, you can change your tax credits with your spouse and stuff like that. So it's actually really useful to see.
Yeah, and you know what, we found ourselves at home that when we weren't claiming things that we should have been claiming for, you know, like bin charges that we all pay and things like that, health bills, that kind of thing. So you can claim these things back. So it's handy to have it anyway.
Yeah, regardless. Very good.
So I would suggest, like, create that account regardless is the recommendation there.
Yeah, and it's pretty easy. I think we're going to send out in the pack step-by-step guide anyway. It'll show you My Account and that. So
yeah, why not?
Brilliant.
The next thing I'd suggest, look, is speak to an advisor and clarify your entitlements. So the worst thing, you don't want to just, you know, somebody could Google this, as we said earlier, and put in too much money and then find out,
like, Mary could have put in 22,000, but she, you know.
Yeah, and then she finds out, look, I can't get this tax back, and I also can't get my money back. It's locked there until she's retired.
Yeah,
but,
okay.
you know, it's really important to get the right advice. And as we said earlier, you know, a lot of the radio ads will say, look, just get your money into a pension. But equally, talking to an advisor is to find out how you're going to take it out in retirement.
Yeah, and going back to the people who it doesn't suit, you could be one of them.
Absolutely.
Right, okay, so. And as I said, if you speak to IPF, and we'll talk to you in a minute about how you can do that, if it doesn't suit you, we will tell you.
We'll tell you, absolutely
yeah.
Right, yeah.
And then the next one, we speak to your spouse, partner.
Yeah, so like the idea behind this is that, you know, get your spouse or partner involved if you want to, you know, and see that they have allowances for 2021. So quite often we find people in the public sector, their spouse or partner might actually be in the private sector and may have no pension. And, you know, if they, as we said earlier, if they don't use this allowance, they lose it.
Right.
You know, so again, it's not too late for them to create something themselves if they want to, and use tax advantage to their advantage, you know.
Brilliant. So the step-by-step guide we're going to send to everybody, Tom, they should read and follow that. Like, is it simple enough, or is it?
It is, you know, it's really well done, and it has screen prints of each step on the revenue website. So when you're logged in, you know, step 1 is screen printed, step 2, etc. So it's a very easy to follow. Yeah, it really is, you know. The next thing, as you can see it there, is to claim your tax relief straight away. You know, or make your lodgement straight away if you can.
And sooner rather than later. Why is that?
Yeah, the key to that, Claire, as we said, it's about trying to get we're all about getting the refund to the client as soon as possible. Okay, so again, the sooner you get it in, the lodgement in, that is, to the AVC, the sooner you can claim your tax relief. So if you think about it, you know, deadline is 31st of October. It's like doing your Christmas shopping on Christmas Eve, okay? You don't want to leave it late.
Like all the blokes.
No comment. What you find is that if anything goes wrong, okay, you know, for example, if it takes Revenue a little bit of time to send the PIN number for you. You know, if you find your bank takes 4 or 5 days to lodge the money, that kind of thing.
Okay, yeah.
Don't want to run into any of these difficulties with no time, because if you miss the deadline, as we said, it's gone to you.
Yeah.
Okay. But equally, if you do, you know, if you make a lodgement this time of year, for example, and you claim your tax relief straight away, you're going to get it pretty much straight away.
They're quieter.
They're quieter. Yeah, absolutely. Whereas middle to end of October, it's just mayhem. It's very, very busy. Half the country was trying to make last minute lodgements, you know.
Yeah, great. And then we were saying, just like you said, mentioned earlier on, just have a plan for the relief when you receive it, because otherwise, like, money has a way of
it does. And you know, a lot of time people will be taking this money out of, you know, accounts that they might think are savings accounts. They might have it in the credit union, that kind of thing.
That they can't touch.
And they can't touch it. And all of a sudden it's in their current account. And if you like, you know, like myself, if it finds a way in there, it'll find a way out of there, you know. So it's just sometimes it's because in a lot of cases, in most cases, it's a lot of money. So, you know, plan on what you're going to do with it. If you're going to spend it and go off on holidays, do it, but plan it. If you want to invest it, maybe do something nice with like that. Yeah,
excellent. And then we had a few don'ts. So we said leave it until the last minute. We've mentioned that.
Yeah.
Don't proceed without advice. That's a very strong message for this.
Yeah, if nothing else, that's the key. You know, it's easy, as we said earlier on, these online gurus that'll say, you know, get X amount in, get the tax relief. Honestly, without advice, don't. You can make big mistakes. You know, get one-to-one advice.
And then what's this last one here? To overstretch yourself, Tom?
Yeah, so I think that's important. Like it is very attractive to make a large lump sum lodgement to an ABC and get a large tax relief tax refund.
Yeah.
But you have to look and make sure it's affordable. Okay. And that's part of what we would do. You know, if you're, you know, let's say you might have 20 years to go to retirement, you really don't want to overstretch yourself, because you'll be a long time waiting for this money to come back to you.
Yeah, and remember, it's not coming till you retire.
It's not coming till you retire. Now, in fairness, if you've only got 18 months to go and you've shortfalls and you want to throw the kitchen sink at it and it makes sense, we'll tell you that it makes sense. You know, it's such a short time before you get it back. But a lot of people will just look at the big amounts, the big tax refund, and maybe overstretch themselves or tend to want to overstretch themselves. So you just don't want to leave yourself short. It's nice to have a bit of a backup fund as well. Like, don't put all your money into this, for example, you know.
Yeah, that's perfect. And I had a few other things that we meant to add on to here was if people are making an EFT, okay, just to make sure they use their policy number as the reference for it, and to take a screenshot for their advisor.
Yeah. So you know, if you're able to make an EFT, electronic funds transfer through your bank, simple thing to do is just take a screenshot and email it on or WhatsApp it on to your advisor, and we can track and trace that then straight away. You'll find a lot of people tend to lodge the same amounts, whether it be 10 grand, 20 grand,
whatever it is.
And there's a lot of these same amounts going in.
They will find out who it is, but it's easier just to have the policy.
Oh yeah, we'll find it. But if it says, you know, Joe Murphy, as we were saying earlier on, and has an amount on it, we'll get that allocated straight away.
And then I think one other thing as well that we find is that if someone's making it a check or a bank draft, that it's not to Irish Pensions and Finance. It has to be to New Ireland or Zurich. So
yeah, whoever the ABC provider is, that's key as well. Yeah, absolutely.
Great. So that's some very good advice. Now, I know we had a lot of other queries about other tax reliefs, so we'll obviously send this on. You can find out a lot of these at revenue.ie, citizen information. And as we said, Tom, you were saying the My Account actually gives you kind of a good...
gives you a good steer on these things, you know. So it's really good to have a My Account anyway, because, you know...
I think so too.
Yeah.
Now, okay, so what happens next? As we said, Sarah Connolly tomorrow morning, and thanks very much, Sarah, for organising it, is going to send... she's going to send a link just to register your interest in submitting a lump sum. So you can fill that out, and then one of the advisors will be in touch with you. We're also going to send the information pack with those links and stuff like that. If you want to email us, you can get us at webinar@ipf.ie. There's our phone number, as we said, that you'll get straight through to the service centre. You'll be speaking to a financial planner there, live on the phone. Grand. Okay, so Tom, before we open up the chat for any questions for people, remember we said we have €100 off one voucher to give away. So
the big question.
Sarah's going to open the chat function. The first person with the right answer is, what is Claire Hanlon's current title? Oh,
wow.
They're coming right in.
On the ball there, all right.
So who have we got, Sarah?
Okay, I think the very first one in there is Jordan P. So that was the very first one in. So well done, Jordan. You'll get
That's a
your
couple
one for
euros,
all
yeah,
voucher
so-
post.
Yeah, the answer is COO.
Jordan won't be left claiming his tax relief last minute anyway.
Yeah, you'd have his 100 euros off.
He'll be on the ball.
So great. Look, thanks very much. I hope people found that interesting and useful. As I said, we're happy now. We're going to open up the chat for the next 10 minutes. We'll try and answer your questions on the chat. The webinar doesn't have a function for the people who are attending to speak. So if you want to throw any questions up there, we'll try and answer them. If they're really technical, we can take it offline and we can deal with you individually. So Sarah, do you want to shout up a few of the questions we get there?
Okay, yeah. So it had a question from Paul just about the revenue website. Should notional service be put in the amount of ABC contributions relieved under the net pay arrangements?
You need to be careful with the notional service, don't you, Tom?
Yeah, so I think it's probably better if we give was it Paul?
That's Paul, yeah.
Get his contact details and we'll maybe run through that individually, just to make sure we were talking with the right thing there. Yeah.
Okay.
I think you do need to be careful though, because
yeah,
the revenue have a different view on notional. So
notional,
yeah, we need to be careful.
Okay,
yeah.
Perfect. We'll just give another minute or two there, just if there's any more questions.
Annuities, Tom.
Yeah.
Somebody wants to ask about
Annuities, yeah.
annuities and why you would go that route. So I think
Okay.
you can take that.
I suppose the key question now, like for a long time, annuities, really back in the day, annuity was the only show in town. You used to save up your money through a pension pot in order to buy an annuity. Okay.
And there wasn't approved retirement funds. There are
Yeah.
many years in existence now. Like they're
not that long really,
Yeah.
It used to always go to an annuity, and the problem with that in the past was, if you think about the current state of play we are at the moment with money, annuity rates are based on the value of money essentially. Okay, and in Europe the value of money, although it's increasing quickly now, has been negative for quite a long time. So if you took an annuity basically is you buy a pension for the rest of your life. So if we take the example of Joe earlier on, I think he had 100 grand, he took out 20 grand tax free.
Yeah.
He would use 80 grand to buy a pension income for the rest of his life. But if he did that today, he, depending on his age, etc., he'd get very little money for it. Okay. So an annuity,
And he has to live a certain amount of time to break even, isn't it, kind of thing?
Yeah. So, and that depends on the rate that he gets. And at the moment, annuity rates, generally speaking, are quite low. So the question are when to look at annuities or when interest rates are very high is number one. Annuities will suit some people if they're completely adverse to risk, that they just want to put their money in something that guarantees them an income for the rest of their lives, but it's a very personal decision. And at the moment,
and I mean, I think when we're doing the retirement planning, which we do from 5 years out, we call it retirement, glide path. We will give people options to look at the annuity.
Yeah.
And we can line up the pros and the cons, and they can make a decision.
Yeah.
And I mean, the thing I think is interesting, Tom, is like if someone has a big pot of money, they can do a mix and match.
Mix and match,
an ARF, or they can go to ARF, and then if they decide, actually, I want an annuity, you can buy an annuity with an ARF.
Yeah, that's a very...
If you go annuity, you can't go backwards.
You can't go back, yeah. So an ARF gives you that option at any stage, whereas the annuity doesn't. And it's worth noting that if you die, the annuity, generally speaking, is gone with you. You can get annuities that will pay out to a spouse
for a certain amount of years.
In order, if they do that, it means they're generally paying you less upfront anyway as a pension.
Yeah.
So again, it's worth getting the advice on it though.
But we'll definitely, if someone has questions and it's something they want to explore as they get to retirement, we can get them quotes and stuff like that.
Sure.
Perfect,
Absolutely.
There's just one more there, Tom, just to clarify around the difference between gross earnings and net relevant earnings. So when you're applying, say, your 35% for someone over the age of 55, is that on your gross income, or is there another figure you use for that?
So really what we're talking about here is their gross income.
Okay.
When it comes to claiming the tax relief, that's what we're looking at. Net relevant earnings are important, but it's not part of what we're looking at here for figures.
Yeah. Okay.
We can give the clients a little checklist of things to get just to make sure we're 100% anyway.
Yeah. Okay, perfect. And there's just another couple of questions just around other types of tax relief again, but I think really the the citizens information and the revenue website are really the place to go.
They're
them.
brilliant for those. Yeah,
Yeah.
exactly.
Yeah. So they'll, and again, like Tom was saying, on your My Account, we'll be able to break that down for you and claim it through there. Yeah, perfect. Okay, I think that's everything question-wise, but
yeah,
as
well,
we
as I
said,
said, you know, we'll be in touch, and
Yeah.
then when people book in, they might have thought of more questions in the meantime.
Sure.
So,
yeah, absolutely.
Tom, thanks very much for joining us.
Thank you, Claire. Thanks, Sarah.
And Sarah, thank you very
everyone who
much
signed
for
in, logged in.
organising
Thanks, guys. That was great.
everything.
Thanks, Lydia. Thank you.
And everybody have a lovely evening, and yeah.
Right. Thanks again. So,
Thanks.
bye-bye.
Bye.